Dear student, in this revision webinar, we will going to discuss risk management. The risk management section of FM covers currency risk as well as the interest rate risk. There are two areas. This topic is being examined in section A as OTQs, or there might be a section B 10-mark question. Usually there will be a 10-mark MTQ. So very important area for the exam. So let's begin with the currency risk management. Now, first of all, let's understand that what is exchange rate? How we can define an exchange rate? An exchange rate is the rate at which one country's currency can be exchanged with another country's currency. So normally we write exchange rate as 1 GBP is equal to USD. Suppose we can write in this way. This is one way we can write the exchange rate. Now it says that if you have 1 GBP, you can get 1.50 USD. So 1 GBP is equal to how many USD? Now see, this is the base rate. And this is the reference rate. Base currency, so you can say this is base currency, not rate, base currency. And it's term currency or reference currency. So if one unit is written here and GBP is domestic currency, then we can say that this is an indirect quote. So in an indirect quote, the base currency is always a domestic currency and the reference currency is always a foreign currency. So if you have to convert foreign currency into local currency, you have to divide by the foreign currency rate. Suppose, for example, you have to receive 100,000 USD. How many pound sterling will you get against this? So we'll divide this by the relevant rate and you will get the relevant GBP. Now, there are two types of rate. One is called the spot rate and another is called the forward rate. A spot rate is the exchange rate which is available for immediate delivery. If you want to buy or sell currency and the settlement is immediate, that means this is called a spot rate. And forward rate is when you have to deal, buy or sell at a future date. For example, if you want to buy foreign currency after 3 months, then the bank will quote a rate now, but for the future settlement, and this is called a forward rate. Typically, whether it's spot rate or forward rate, the rates are given as the buying rate and the selling rate. So we have to decide what is the buying rate and what is the selling rate. Suppose these two are the rates given against 1 GBP, USD 1.5020 and 5080. Which one is a buying rate and which one is a selling rate for the bank? We'll keep in mind from the bank's point of view. So remember this rule for indirect quote. This rule, I'm telling you, is for indirect quote. That bank sell low and buy high. So in an indirect quote, always remember that the low rate is a selling rate for the bank and high rate is a buying rate. So this is the high one. So it is the bank's buying rate or a bid rate, and this is the bank selling rate and also known as offer rate. In an indirect quote, remember, this is for indirect quote. Now, in order to manage currency risk, When we say currency risk can be classified into three types. One is the transaction risk. Other one is the translation risk. And the third one is economic risk. By definition, transaction risk is the risk when you enter into a foreign currency transaction. For example, you have a customer in USA and you have to receive USD. You have a supplier in USA and you have to pay the supplier in USD. So that creates a problem that the exchange rate might go down or it might go up, create a risk for you. That risk is called, it's a transaction risk. And we normally hedge this kind of risk, that is transaction risk. Translation risk is that is going to affect your financial statement. Suppose you have a subsidiary which is preparing accounts in USD and the parent company is preparing accounts in PKR, in Pakistani rupees. So you have to convert the USD into PKR, the local domestic country's currency. So when you convert the financial statement of a subsidiary into the parent company's local currency, there will be exchange gain or loss, and that exchange gain or loss hit the financial statement. This is called translation risk. And as far as the economic risk is concerned, it affects your present value of future cash flows. Or you can say that it affects the position of an entity against its competitors. Due to changes in exchange rate, one company is getting some benefit and the other company is not getting that kind of benefit. So it affects the international competitiveness of a company. So transaction risk when you enter into a transaction, translation risk when you have a subsidiary, economic risk is even if you don't have any currency risk exposure directly, but it can affect you in terms of if your competitor is dealing in foreign currency, and if that foreign currency's appreciation or depreciation is giving the company benefit, it might be a problem for you and you might lose your competitiveness. This is called economic risk. So we normally manage those risks, like in case of transaction risk, we have to hedge our currency risk. And how we can hedge? Hedging means to reduce the impact of the risk. And how we can do this? We have few methods. Some are called internal methods and some are called external methods. And from the examination point of view, the important external method that we have to apply is forward exchange contract. Typically, there is a question on forward exchange contract. And an important one is money market hedging. Money market hedging is also very, very important topic. Similarly, we have some derivatives like currency future contract. We have currency option contract. For internal method, we might use netting, lead payment, leading. We can delay payment, that is called lagging. Also, we have an option called matching. So these are the possible options, and you must have clarification in terms of both calculation and theory against this. But more important is that you must know how to calculate something against forward exchange contract and money market hedging especially. So let's begin with forward exchange contract and money market hedging. So in forward exchange contract, how we can mitigate risk? Suppose, for example, it is 1st January 2023 today, and the company is expecting a receipt of USD 500,000 on 31st March 2023. Company is based in UK. Company is a UK company and the client is in USA. So the company is thinking about, because the company is to receive 500,000 USD, what is the risk right now the company is facing? That is the depreciation of foreign currency. So the company want to mitigate that risk, that if foreign currency depreciates, that the company will not get any kind of loss. So company can do what? Contact with a bank and enters into a forward exchange contract to lock the exchange rate for this deal. Bank will quote you a forward rate, and accordingly we will fix that rate, and on the maturity, that is 31st March, we will convert USD into GBP as per the agreed forward exchange rate. So this is basically the concept of forward exchange contract. In money market hedging, we don't contact with any bank, but rather we manage currency risk using the money market function of lending money or borrowing money through money market. Money market is a market for short term, 1 year usually. So we can do this by lending money or borrowing money, and you can manage your currency risk. How? In case of the receipt of foreign currency, how we can manage this? So suppose the above example, 500,000 USD I have to receive in future. What we can do? So we borrow appropriate foreign currency, that is USD in this example. Now, and this is not the whole 500,000, present value of receipt. And then immediately convert this into local currency using the spot rate. And then immediately deposit this into local bank account or the domestic currencies bank account. Now these three are the steps. Step number 1, step number 2, step number 3. Now, as a result of this, we have a liability. Here we have a liability. We have to pay. Here we have a deposit, that is an asset. At maturity, what we have to do? We'll collect receipt from customer in USD. Suppose 500,000 USD. So what will we do? We'll use that receipt to pay off the loan, borrow appropriate foreign currency now. So we'll settle our foreign currency liability through this receipt, and then we'll withdraw our local currency deposit amount. So as a result, we'll get GBP against 500,000 USD without having any relationship or contract with a bank as we did in forward exchange contract. And in case of the payment of foreign currency in money market hedging, what we'll do? Step number 1, now borrow appropriate local currency, not foreign currency. And then convert this in foreign currency immediately using the spot rate. And then deposit this foreign currency amount in a foreign currency bank account. Similar process, but in the reverse direction. At maturity, suppose you have to pay USD 500,000 to your supplier. From where you can pay? What you will do? So in your deposit account, you have the 500,000 USD. So pay from your deposit account. Now you have already borrowed appropriate local currency. Now pay that local currency loan. So at the end, you have to pay USD 500,000, but you're paying it in local currency, that is GBP. So you have converted your foreign currency liability in your local currency. So this is a typical exam question, and it is basically in September, December 2020 exam question. The scenario relates to 5 questions. Marigold Co is based in country which uses the dollar as it is home currency. So this is the domestic currency, USD. Marigold Co has a wholly owned subsidiary based in a country which using the MS at its currency. This is the foreign currency. The subsidiary's financial statements are prepared in MS. Due to economic uncertainty in both countries, an exchange loss of 100,000 is expected to occur after consolidating the result of the subsidiary into group's accounts. Marigold is expecting a receipt of 300,000 MS from the subsidiary in 3 months' time, which it wishes to protect against exchange rate movement. The following information is available. So we have an exchange loss as a result of conversion from group's financial statement, and we have an expected receipt in 3 months' time in foreign currency. The current rate is given $1 per MS. MS per $1. So the base currency is $1. So it's an indirect quote. And as we know that in indirect quote, banks sell low and buy high. So a 3-month forward rate is given. Now you can see here, as there is a case of receipt. So we will receive MS 300,000. So we will sell MS to a bank, and bank will buy, and bank sell low and buy high. So we have to choose the high rate as the bid rate. This is the bid rate, and this is the bank's offer rate from the bank's perspective. Now we have been given money market rates. So this is the deposit rate. This is the borrowing rate. This is the annual deposit rate of in MS. This is the borrowing rate in MS. This is the deposit rate in US. This is the annual borrowing rate in US. What type of exchange rate risk would Marigold experience with the $100,000 loss in its consolidated financial statement? So as we have discussed the definition, that if you are converting your subsidiary into local currency, that is a risk which is called the translation risk. So this is the translation risk. If Marigold uses the forward market to hedge the receipt, what amount will be received to the nearest dollar? Now the important thing is that we have a receipt of 300,000 MS. We have to correctly choose the forward rate. So as bank will buy, so the correct rate is a bid rate which is more than the selling rate 1.1125. So simply divide this MS into 1.1125 and there will be a dollar rate which is approximately 269663 to the nearest dollar, 269663. So in case of forward exchange, you have to just identify a suitable rate. And in case of conversion of foreign currency into local, just divide that by that suitable rate and you will get the relevant figure. Match the appropriate value to the relevant target in order to reflect what amount Marigold will borrow and deposit if it uses the money market to hedge the MS receipt. So in case of receipt, my first step is borrow foreign currency, borrow MS. So as I am borrowing MS, so I have to use the borrowing rate of MS. And then deposit the other currency. So how much to borrow MS? So MS borrowing rate is annual 4%. So MS borrowing rate is 4%, which is annual. We have to convert this into quarter. So 1/4, and that is 1% per quarter. Now we have to convert MS 300,000 into present value using this rate. So 300,000, how we can find present value? Divided by 1 plus 0.01, 1 upon R. And the USD that we need to borrow now is 297,030. This is we need to borrow now. Appropriate foreign currency, which is the present value of the receipt, 297,030. Always remember to convert this into the relevant quarter. So this is the answer. And then we'll convert this into local currency. So we have foreign currency, we'll sell foreign currency, bank will buy. So spot rate, now we have to choose the spot rate. And spot rate, bank's bid rate, spot bank will buy at 1.1250. So convert this 297,030 into local currency, 1250. So this is 264,027. This we need to deposit now. In money market hedging, it's very important to correctly identify the deposit and borrowing rate with the exchange rate, and it's advisable to just memorize these steps and its calculation. Then you will be able to properly solve this money market hedging question. Another question is, Marigold Co is now considering the use of an option. An option is a right, but not the obligation to either buy or sell currency. So Marigold is now considering the use of an option to hedge the currency risk. Its bank has offered an over-the-counter option. Option can be tailor-made, which is over the counter, or exchange traded with an exercise price of 1.1250 per USD. Which two of the following statements concerning the options are true? Number one, the option will be more expensive to set up compared with forward contract and money market hedging. Yes, option contracts are very expensive as compared to others because you have to pay the option premium, which is a non-refundable amount. Why? Because option provide you a flexibility that either you can exercise or lapse the contract. So that's why you have to pay extra premium. Number two, an imperfect hedge will result as the option will be for a standard amount of currency and only a whole number of contracts. This is not true because this is true with exchange traded options. This is not true with an over-the-counter option. If the dollar was to strengthen against the MS, Marigold Co is likely to worse off by using the option compared to either the forward contract or money market hedging. Now see, we are expecting receipt. So our risk is the depreciation of MS. Depreciation of MS means appreciation of dollar. So if dollar depreciates, if MS depreciates and dollar appreciate, it means the hedge is appropriate. So it means that we have to pay premium. So it is worse of paying option as compared to forward and money market hedging. So this option is correct. Using an option hedge will mean that the company is obligated to exercise option. It's not obligation, it is a right, but not the obligation. So it's not true. Next question is, Marigold is unsure whether to use a forward contract or a money market hedging and is comparing the relative advantage and disadvantages of two. Which of the following statement is true? So we are comparing advantages and disadvantages. The forward contract has the advantage of being tailored specifically to Marigold's course requirement, but the money market hedging will be a standardized instrument resulting in an imperfect hedge. It's not true because money market hedging is also a standard. The forward contract will result in Marigold receiving the dollar equivalent to the MS received in 3 months' time, whereas the money market will provide MS gold with dollar received today. It's not true. In the sense, it might be true that in case of forward exchange contract, you will get the money. But in case of money market hedging, as the mechanism is that we have to borrow now, so we'll get the dollar received today. So it's correct. Means another two options are not correct. Let's see that. The forward contract will result in the effective rate of exchange being fixed, where money market will allow to benefit from the favorable movement. Now, in case of both forward and money market hedging, we cannot get benefit of favorable movement. Marigold Co will be obligated to fulfill the forward contract, whereas the money market hedging could be traded on an exchange. It's not an exchange traded. Both are tailor-made. So answer is B. So let's discuss another question. Zicto is a medium-sized company whose ordinary shares are all owned by the member of one family. The domestic currency is dollar. It has recently begun exporting to an European country and expect to receive 500,000 euro in 6 months' time. The company plans to take action to hedge the exchange rate risk arising from its European exports. The company could put cash on deposit in the European country at an annual interest rate of 3% per annum. In European country, this is the deposit rate, or can borrow at 5% per annum. This is the borrowing rate. The company could put cash on deposit in the home country at an annual rate of 4%. This is the deposit rate in local, and borrow at 6%. So in terms of EU or in terms of USD, the deposit rate is 3% per annum. And here the deposit rate is 4% per annum. And the borrowing rate is 5% per annum and 6% per annum. While inflation in the home country is 4.5% and inflation in the European country is 3%. Inflation is given because purchasing power parity can be used to predict exchange rate. The following exchange rates are currently available. Current spot rate is given 1 USD versus Euro 2, that is the indirect quote. 6 month forward 1.99, 1 year forward 1.981. Zicto wants to hedge its future euro receipt. Zicto is also trying to build an understanding of the other types of currency risk and the potential impact of possible future interest rate and inflation rate changes. Question number 1. What is the dollar value of a forward exchange contract in 6 months' time to the nearest whole number? Now, we have to select the forward exchange rate. So there is only one rate given, that is 1.990. So we have to convert the receipt of 500,000, very simple, 500,000 euro into dollar using this rate, which is 251,256. Next is, what is the dollar value of a money market hedge in 6 months time to the nearest whole number? So now we have to apply the money market receipt case. So we have to, first of all, convert this into present value. We need to have a borrowing rate in euro. So what is the euro borrowing rate? Euro borrowing rate is 5%. And it is a case of 6 months. So borrowing rate is 5%. Semi-annually, it's 2.5% for 6 months. So we have to convert the euro 500,000 into present value 0.025. So it's euro 487,805. This is the present value of, this is the present value. My first step is to borrow appropriate euro now. So this is the appropriate euro now. And I have to convert this into local currency using the spot rate. The spot rate is 2. So 487,805 divided by 2. This is the dollar value now, 243,903. Now I have to deposit this dollar into a 6-month deposit account. Deposit account rate is, deposit is 4%, 4% annually. So it means 2% for semi-annual. So I'll deposit this 243,903 at a rate of 2%. So after 6 months, what I'll get, it's 1 plus 0.02 future value. So that is 248,781. So the answer is 248,781. What is the 1-year expected spot rate predicted by the purchasing power parity theory to the 3 decimal places? The formula for purchasing power parity is, you have to multiply 1 plus inflation in foreign currency, foreign country, divided by 1 plus inflation in local. So local inflation is given 4.5%, foreign is given 3%, and current spot rate is 2, 1 plus 0.03, 1 plus 0.045. So as a result, the answer is 1.971. This is the expected rate in 1 year's time. Euro per USD, 1.971 to 3 decimal places. Are the following statement true or false? Purchasing power parity tends to hold true in the short term. This is not true. Purchasing power parity is applicable in long term. Expected future spot rates are based on relative inflation rate between 2 countries. This is true. Current forward exchange rate are based on relative interest rate between 2 countries, and this is also true. Are the following statement true or false? Transaction risk affects cash flows. This is true, because in case of a transaction risk, it affects the incoming or outgoing. Translation risk directly affects shareholders' wealth. It false. Translation risk affects the financial statement, not the shareholders' wealth directly. Diversification of supplier and customer base across different countries reduces economic risk. This is true, because economic risk is that affects your international competitiveness as a result of exchange rate risk. So if you diversify into supplier and customer across different countries, it might offset the risk against each other. Now, another thing is about interest rate risk. For example, if you have to borrow money and you have to borrow at a floating rate, So for the borrower, the risk is that the floating rate might be increased. That is, the LIBOR might be increased. So the borrower wants to hedge the increase in the market rate. But it is also a possibility that the borrower wants a fixed exchange rate. And in case of a fixed exchange rate, the risk is that the exchange rate might go down. So how the borrower can manage interest rate risk? That is to be hedged using both internal methods as well as some external methods. In our syllabus, the theoretical discussion is important. So in internal methods, we have option like matching, smoothing, assets and liabilities management. In case of external method, we have FRA, forward rate agreement. We have future contracts, interest rate future. We have option contracts. We have caps, floor, collar, as well as we have interest rate swaps. These are the hedging methods. So the common calculation can be asked in the exam is about FRA. So FRA works like a forward exchange contract. For example, in case of a borrower, a company has to borrow, suppose 10 million in 2 months' time for a period of 3 months. And the risk is that interest rate might go up. So we can write this as 2-5 FRA. The contract will start in 2 months' time and end in 5 months' time. So the bank will fix, the FRA bank will give you a rate. Suppose it's 5%. Now what would happen if the rate increases to 7% or the rate go down to 3%? In first case, as we have committed a rate of 5%, so FRA bank will pay us the difference. And if rate goes down, we'll pay the difference to FRA bank. So we cannot get benefit of an favorable movement, but we can protect against the adverse rate movement. This scenario relates to the following 5 questions. The company's finance director is concerned about the effect of future interest rate on the company's, has been looking at the yield curve. Yield curve shows the relationship of interest rate and the term to maturity. And we might have a upward slope yield curve, and we might have a downward slope yield curve. And the theories that can explain why interest rates, the curve is upward slope or it might be a downward slope. The company whose domestic currency is dollar plans to take out 100 million loan in 3 months' time for a period of 9 months. 3 months' time for a period of 9 months. That means the FRA would be 3-12. The company is concerned that interest rate might rise before the loan is taken out, and its bank has offered a 3-12 forward rate agreement at 7.1, 6.8. So 7.1 is basically the borrowing rate fixed. The loan will be converted into peso and invested in a 9-month project, which is expected to generate income of 580 million peso, with 200 million peso being paid in 6 months' time and 380 million peso being paid in 12 months' time. The current spot rate is 5 peso per 1 USD. The following information is given on interest rate, on short-term interest rate. Dollar rate is 6.5% per annum. Peso's rate is 10% per annum. As a result of the general uncertainty over interest rate, the company is considering a variety of ways in which to manage its interest rate risk including the use of derivatives. In relation to the yield curve, which of the following statement is correct? Expectation theory suggests that deferred consumption requires increased compensation as maturity increases. This is about the liquidity preference theory, not the expectation theory. So it's wrong. An inverted yield curve can be caused by government action to increase its long-term borrowing. So it results in an upward yield curve rather than an inverted yield curve. A kink in the normal yield curve can be due to different yields in different market segment. So this is a possibility that if we have a different interest rate in different market, the yield curve, there is a discontinuity is possible. Question number 307. If the interest rate on the loan is 6.5 when it is taken out, what is the nature of the compensatory payment under the forward rate agreement? So we have fixed FRA at 7.1%. If the interest rate is 6.5, so we have to pay the difference, 7.1 minus 6.5, that is 0.6 to the bank. As we are taking a loan of 100 million for a 9 months period of time, so 0.6% is the difference, multiply by 9 divided by 12. So we have to compensate 4,50,000. We have to compensate. So it's 4,50,000. We have to pay to bank. Using exchange rate based on interest rate parity, what is the dollar income received from the project? Now, as a result of the interest rate parity, so we have to find out the forward rate. We are expecting a receipt of 580 million peso, 200 million and 380 million in 6 months time and in 12 months time. So we have to find out the forward rate. Spot rate is given, interest rate is given. So in 6 months time, what is the forward rate? So we have to use the interest rate parity formula. Interest rate parity. One plus interest rate in foreign country divided by 1 plus interest rate in home country. So for a 12-month forward, 1.10, 1.065. This is the peso rate 10% and dollar is 6.5%. So as a result, the forward rate is 5.1643 peso per dollar. And for a 6-month forward, same formula, but then we have to convert this 10% into 5% for a half and 6.5% into 3.25%. So accordingly, it is 1.05 over 1.0325 and the rate is 5.0848 peso. These are the two forward rates on the basis of interest rate parity. Now convert 200 million 5.0848. 200 million we have to receive in 6 months time and 380 million we have to receive in 12 months time. So 6 month forward we have to use which is 5.0848. And for 380 million, we have to use 5.1643. So 200 divided by 5.0848, it's 39.33. And we have 380 over 5.1643, 73.58. And this is the total amount, 39.33 plus 73.58 is 112.91. So up to one decimal, it's 112.9. Answer is D. In respect of the companies managing its interest rate risk, which of the following statement is or are correct? Internal hedging methods. Smoothing, it is an interest rate risk hedging technique which involves maintaining a balance between fixed rate and floating interest rate. This is the correct definition of smoothing. For example, you have to borrow money. So borrow money, some using the fixed rate and some using the floating rate. So that the risk is automatically hedged. Assets and liability management can hedge interest rate risk by matching the maturity of assets and liability. Again, this is the correct definition. So statement both 1 and 2. In relation to the use of derivatives, which of the following statement is correct? Interest rate option must be exercised on their expiry date if they have not been exercised before then. It is not mandatory to exercise. So must be exercised is wrong with interest rate option. It is a choice. The company can hedge interest rate risk on borrowing by selling interest rate future now and buying them back in the future. In case of interest rate future, the strategy is sell now and borrow later. So this is the correct definition. An interest rate swap is an agreement to exchange both principal and interest rate payment. Interest rate swap is only the exchange of interest rate, not the principal. P can hedge interest rate risk on borrowing by buying a floor and selling a cap. Buying a floor and selling a cap. It's reverse because if you have to manage interest rate, so you have to buy a cap and sell a floor. So the correct answer is B.